Community banks have certain characteristics that uniquely define them. They tend to have a geographic focus. They tend to focus on relationships, relationship banking. They also tend to hold their loans instead of securitize them. And they also tend to be funded more by deposits than larger banks. In terms of asset size, community banks have typically been defined as those with $1 billion or less in assets. Dodd-Frank used a $10 billion threshold in terms of defining what smaller banks would be exempted from most of the regulations. Community banks make up over 90% of all banks in the system. They've been declining in number over the last 20 years, from about 13,000 20 years ago to about 6,700 last year. They also have gotten smaller relative to the larger banks.
90% of all assets in this country are controlled by 10 banks, which is a very frightening perspective of the too big to fail issue. The concern that we believe and the opportunity that we see at a $3 billion bank like Eagle Bank is we've grown our loan portfolio in excess of 20%. So it just demonstrates that the demand for lending is still out there.
Banks with less than $10 billion in assets comprise almost 60% of small business lending.
It could be a local restaurant, it could be the hardware store, it could be a variety of different local places that are just looking for credit. And it's those type of needs that is going to get us the employment numbers. If you looked at the last data in employment, 81% of the jobs that were recently created from startup companies or small companies.
Dodd-Frank seems to have used a $10 billion threshold when determining what size to exempt from some of the regulations. So, for example, the Durbin Amendment, which caps debit fees, only applies to banks with more than $10 billion in assets. There are extra fees that will be imposed to replenish the FDIC's deposit insurance fund. Those only apply to banks with more than $10 billion in assets.
Dodd-Frank, I think in concept, was good when it started. It's obviously blossomed to an astronomical amount of regulatory difficulty at the bank world. A $3 billion bank, never mind a $500 million bank, can't possibly afford the amount of requirements that Dodd-Frank and very many other regulatory bills insist upon.
Another item that community banks are looking at in terms of the regulatory agenda is the Consumer Financial Protection Bureau. So again, although Dodd-Frank exempted banks with less than $10 billion in assets from primary enforcement by the CFPB, there are still items that the CFPB is going to act on that could negatively affect community banks. So for example, how they define what's called a qualified residential mortgage, or a QRM, could affect community banks.
And Washington is a very much real estate oriented town. Well, Washington's real estate has actually improved over the past 5 years, very different than many other towns throughout the country. So being able to use a standardized program would be great if they understood that our loss ratios at Eagle Bank are very, very low. So therefore, the scrutiny on the real estate portfolio that we have should be much less than in towns where real estate is really deteriorating. You can't take a one size fits all, and that goes throughout the entire banking industry. That's not only the regulatory side from the examiners, but that's from people understanding that Bank of America's needs are very different than what Eagle Bank's needs are, and being able to understand what the difference is, what the requirements are, and what the regulations should be that apply to those different size banks.
There's a couple ways that community banks have been responding to the regulatory environment. One is through an extensive lobbying effort. We count about $50 million that's been spent by the ICBA, the Independent Community Bankers of America, and the ABA, the American Bankers Association, since the financial crisis in the last 4 years. Another response we've seen by community banks, at least the larger community banks, those just below the $10 billion asset threshold, is they've been restraining their growth because they wanted to avoid those tripping those $10 billion regulations until they're ready to exceed them significantly.